If oil really goes to $200, the stock market will not simply have a bad quarter. It will get repriced in a way most investors are not emotionally prepared for. That is the first thing I want you to understand. People hear a number like $200 oil and treat it like a dramatic forecast, a television headline. Another exaggerated crisis statistic meant to frighten ordinary investors into staring harder at the screen. That is not how I hear it. I hear a chain reaction. I hear transport costs rising through everything. I hear inflation pressure arriving exactly when the central bank most needs inflation to behave. I hear the bond market beginning to understand that growth may break before prices cool. I hear the equity market discovering that the story it wanted to tell itself about easy cuts, stable margins, and painless AI expansion was built on much cheaper energy than the world may now get. That is the real issue. Not the number itself, the sequence the number sets off. And if you do not understand the sequence, you are going to do what most people always do in moments like this. You are going to buy the visible winners too late, sell the misunderstood assets at exactly the wrong time, and completely miss the fact that the largest opportunity sits not in the first move, but in the second and third moves that follow it. That is why I want to talk to you about oil, gold, interest rates, and panic as one single machine. Because right now, most investors are looking at these as separate stories. War over here, oil over there, gold doing something weird over there, the Fed trapped somewhere in the background. That is not how markets really work. Markets move through chains. One market pressures another. That market forces a policy response. That policy response destroys one narrative and creates a new one. By the time the public realizes the narrative is changed, the real money is already moving. That is the pattern. And if you understand it, then a week like this stops looking like chaos and starts looking like structure. Now let me say the hard sentence right at the beginning. Gold crashing during a war is not proof that gold is broken. It is proof that the people selling it need something else more urgently right now. That distinction matters enormously, because if you misunderstand forced selling as a broken long-term thesis, you will keep handing your assets to people who understand the chain reaction better than you do. That is the trap. The first wave of a crisis rewards the obvious trade. The later waves reward the prepared trade. Most people only ever see the obvious trade. That is why they arrive late to the visible winners and leave early from the misunderstood winners. Now let us begin where the real sequence begins. Geography, not ideology, not television. Geography. The Strait of Hormuz is one of those places the world ignores until history reminds it that maps still matter. A huge share of globally traded oil flows through a passage narrow enough that nobody serious can look at it and say, that can matter very much. It matters because flows matter. A lot of investors still think in terms of total closure. They imagine the route must literally be sealed shut before the market should respond. That is not how markets price reality. The market does not need a total shutdown. It needs credible danger. That is enough shipping risk rises. Insurance costs explode, carriers hesitate, routes become less economical. Governments begin hoarding. Importers begin paying up. The futures market starts pricing the possibility that physical movement itself will become constrained or prohibitively expensive. That is what matters. And once that begins, the market does not wait for a final outcome. It prices the path of fear. That is why this matters so much. Not because every tanker has already disappeared, because the economics of sending them become unstable enough that the world begins behaving as if supply were already smaller than it officially is. That is how a bottleneck turns into a global asset pricing event. Now, if you want to understand why $200 oil is not a fantasy number, you have to stop treating each energy shock as a new event and start seeing them as part of a historical pattern. The world has already shown more than once that when a major oil-producing region falls into severe instability, crude can reprice with shocking speed, not because analysts become dramatic, because supply chains do not need to fully stop to create panic. They only need to become uncertain enough that buyers stop trusting tomorrow's access. That is the whole mechanism. And once tomorrow's access becomes uncertain, Today, S price becomes the battlefield. This is why I have no interest in debating whether $200 is too extreme. The more useful question is much simpler. What happens to the system if the market even seriously tries to get there? That is the right question, because the attempt itself is enough to break assumptions everywhere else. Now let me explain the first chain reaction. Oil is not just gasoline. That is one of the great simplifications that keeps the public confused. Oil is transport, yes, but it is also logistics. It is food, it is fertilizer, it is manufacturing input, it is plastics, it is chemicals, it is packaging, it is the energy cost embedded in moving, preserving, producing, and distributing almost everything the modern consumer touches. When oil rises hard enough, it is not one price that goes up. It is a cost grid. And that cost grid eventually reaches every business that cannot fully pass it through and every household that cannot fully outrun it. That is why I treat oil spikes as system events, not commodity events. A $200 barrel is not a problem for drivers. It is a problem for margins, a problem for freight, a problem for food, a problem for expectations, a problem for inflation psychology. And inflation psychology matters because central banks do not control prices directly. They control or try to control how much damage they are willing to inflict to stop prices from spiraling. That is where the second chain reaction begins. The Federal Reserve trap, the file you uploaded, puts this clearly. The market went into 2026 expecting rate cuts, but higher oil and higher inflation pressure are now blocking the path to those cuts. That is the real shock under the shock. Faithful cite Fayturn 41 file 0 Fay, that is exactly right. This is the part most retail investors fail to understand until the damage is already widespread. The stock market did not just want lower oil, it wanted lower rates. The entire optimistic case for many growth assets, many leveraged sectors, and many future cash flow stories depended on the idea that the central bank was moving toward easier money. That was the emotional fuel. Cheaper financing later, lower discount rates later, a smoother environment later. Then oil rises. Now inflation becomes harder to tame. Now the Fed cannot cut cleanly. Now the path that was supposed to rescue markets becomes politically and economically uglier. That is why higher oil does not simply hurt consumers. It blocks relief. And block relief is one of the most dangerous things a market can discover after it already spent months hoping for exactly the opposite. Now let me say something more direct. A central bank caught between rising inflation pressure and weakening growth is not a central bank in control. It is a central bank choosing which kind of pain to distribute. That is what we are looking at. If it cuts too early, it risks feeding inflation through a fresh oil shock and convincing the market that price stability is no longer the top priority. If it holds high, it keeps financing conditions brutal for an economy already getting squeezed by energy, food, and margin compression. If it hikes, it risks turning a squeeze into a break. There is no clean move there. That is why I keep saying the important thing is not the next meeting by itself. It is the geometry of the trap. Now let us extend the chain further. Higher rates do not just mean borrowing stays expensive in some abstract policy sense. They move through the entire financial structure. The file explains this in a simple way. More expensive money means lower profitability for rate-sensitive sectors, especially businesses built on borrowing, expansion, and long-duration assumptions. Data centers are one example. The bigger the build-out, the more interest costs matter. Fayturn Fayturn 41 file 0 Fay, that is not a side point. That is central. The market, as most love stories, are often the ones that depend least visibly on cheap financing, while actually being deeply conditioned by it. AI infrastructure, massive data center spending, gigantic capex plans, long-duration software expectations. All of these stories look like pure innovation from a distance. But capital intensity is still capital intensity. If the cost of money remains elevated because oil reignites inflation pressure, then the valuation logic under many of those stories gets hit from below. That is the real chain energy shock. Inflation fear, delayed or canceled cuts, higher financing costs, margin pressure, valuation compression. That is why the market can look so confused in weeks like this. The public sees war and thinks only of defense stocks and oil companies. The serious allocator sees the whole financing ecosystem wobbling. That is a much bigger story. Now let us turn back to gold, because this is where confusion becomes opportunity. People are rightly puzzled when they see a war, higher oil, central bank stress, and then gold selling off anyway. On the surface, that looks backward. It is not backward. Once you understand who is selling, gold did not collapse because gold somehow stopped mattering in a crisis. It sold off because in the first panic phase, people do not sell only the assets they hate. They sell what they can sell. That is a huge difference. The file explains the chain in blunt language. Disruption raises oil, inflation rises, the dollar strengthens, Gulf region actors and stressed institutions sell gold to manage revenues or liquidity. ETF holders get forced out, leveraged positions blow up, and the resulting liquidation turns a supposedly safe asset into a source of cash. Fay file cite Fay turn 41 file. 0 Fay. That is a very good framework. It captures something most textbook explanations ignore. Gold is not only a fear trade, it is also a liquidity source. If you are a sovereign fund under stress, a leveraged fund facing margin calls, a holder of paper exposure that is suddenly underwater, or an institution trying to plug a funding hole, you sell what can be sold. That is why crisis behavior often looks irrational to people who only know the slogan version of markets. The slogan says war means buy gold. Reality says panic means sell what clears. That is why gold can drop hard during the early phase of a real shock. Not because the long-term thesis died, because forced liquidation outruns narrative purity for a while. This is exactly what happened in other major stress episodes too. The first move is often about liquidity, not long-term wisdom. That matters because it tells you not to interpret every sell-off as an ideological vote against the asset. Sometimes it is simply collateral damage from who needed cash that week. Now let me say something that matters enormously. A forced sell-off in a structurally important asset is one of the best opportunities in all of finance if the long-term thesis remains intact. That is the catch. You have to know the difference between forced liquidation and real impairment. Gold being dumped because liquidity is scarce is different from gold being permanently discredited as an asset. One is a temporary ownership problem. The other is a structural thesis problem. Confusing the two is how ordinary investors keep handing good assets to stronger hands during the ugliest weeks of a cycle. That is why I care so much about position, not only opinion. Now let us move to the dollar. When inflation fear rises, the dollar can strengthen in the short term because rate expectations change. Foreign capital seeks nominal safety. And the world still lives under a dollar system, whether it likes it or not. That is part of why gold can be pressured at the same time the macro environment looks increasingly unstable. Again, this confuses people because they want one clean story. Oil up should mean gold up, war should mean gold up, Fed trap should mean gold up sometimes, yes. But the market gets there through phases, not slogans. The first phase is dollar and liquidity dominance. The second phase is policy confusion. The third phase is recognition that the system will eventually have to choose support over purity. That third phase is where gold often begins looking much stronger. But people who have never learned to think in phases keep reacting to phase 1 as though it invalidated phases 2 and 3. That is a costly mistake. Now let us widen the lens and talk about sectors, because the file does something helpful here. It does not only explain the macro chain, it asks where money should or should not go. Its instinct is directionally good. Do not blindly chase what already spiked. Pay attention to energy infrastructure. Be selective with defense. Think about pricing power. Stay cautious with airlines, banks, and rate-sensitive sectors, and understand that the market moves through phases from everything sells to true winners emerge. Fay file site Fay turn 41 file 0 Fay. That framework is more valuable than the specific ticker hunt. And I agree with the central principle. The obvious trade is usually most attractive before it becomes obvious. By the time the public is breathlessly announcing that energy is the winner, the first move already happened. That does not mean all energy exposure is finished. It means you must distinguish between the visible beneficiaries and the structurally advantaged beneficiaries. I prefer toll collectors, pipelines, storage, maintenance infrastructure, domestic networks that earn because the system must keep moving energy, not because they guessed the commodity price correctly. That is much more Buffett than buying the loudest oil name after a spike. It is the difference between owning the casino and betting on the next roll. Now let me talk about airlines, because this is where the file is absolutely right to be skeptical. Airlines are among the most fragile business models in normal times and often among the first to feel energy stress in abnormal times. They have weak economics, enormous operating leverage, little pricing grace relative to cost spikes, and heavy exposure to exactly the input. Now behaving like a weapon, I have rarely admired the economics of the airline business, and this environment does not improve my opinion. If you want to understand what a structurally impaired sector looks like in an oil shock, airlines are an excellent teacher. Now, utilities are more nuanced. The file treats them cautiously, and I understand why. Many utilities look defensive on the surface, but not all have immediate pricing flexibility. Some live under regulatory structures that delay pass-through, which can turn inflation and input stress into temporary margin pain. Again, the principle matters more than the category label. Do not buy safe, merely because a sector sounds safe. Understand what the cash flow can or cannot pass through. Pricing power is what matters. This is why big tech and healthcare become interesting in these setups. Not because they are immune to macro pressure, but because many of the strongest businesses in those fields can raise prices, retain customers, or hold margins better than ordinary firms. Pricing power is a form of crisis insulation, and in a world where energy lifts the cost of everything, insulation matters. Now let us come back to the bond market, because this is where the next turn usually begins. The public loves headlines, the bond market loves arithmetic. I trust arithmetic more. If oil keeps rising and the market continues, believing inflation is the bigger story. Then long yields can stay ugly and the pressure on equities can continue. That is phase 1 and phase 2. But if oil rises enough to start destroying demand faster than it raises inflation expectations, the message can flip. Now recession risk becomes more important than price pressure. Now yields can fall even with oil elevated. Now the market starts anticipating support, stealth accommodation, or future cuts, once the damage becomes too politically or financially painful to ignore. That is the phase change I care about most, because the greatest money is often made not in the obvious winners of the first panic, but in the crushed assets that rebound hardest when the system pivots from inflation fear to growth fear, and then from growth fear to policy rescue. That is why I keep telling people to think in chains. If all you do is stare at the current week's headline, you will buy what already moved. If you watch the bond market, the funding stress, and the likely policy response, you can begin positioning for what comes after the panic. That is where serious returns live. Now let me be very practical. What should an ordinary investor actually do with this framework? First, stop thinking in binaries. Do not ask, is gold broken? Ask, is this forced selling or structural failure? Do not ask, will oil definitely hit $200? Ask, what does the system do if it even starts moving credibly in that direction? Do not ask, should I buy the war winners? Ask, has the first move already happened, and where are the toll collectors rather than the headline names? Do not ask, is the Fed cutting or not? Ask, what damage path forces the next policy concession? Those are much better questions. Second, respect energy exposure in your portfolio, whether you intended to have it or not. The file suggests checking how sensitive your holdings are to oil rates and margin pressure. That is excellent advice. Fay file site Fay turn 41 file 0 Fay. a manufacturer with high input dependence, a growth stock dependent on cheap capital, a bank sensitive to long-end instability, a consumer business with weak pricing power, a REIT carrying heavy financing exposure. All of these are oil risk stories in disguise. If the shock persists, the public thinks sector labels tell the whole truth. They do not. You must ask how energy pressure and rate pressure flow through the business model. Third, do not gamble on headlines. This is the most important thing. A lot of people hear a video like this and think the goal is to get rich by Friday. That is not the goal. The goal is to stop making foolish moves under stress. If you are already over-leveraged, reduce leverage. If you are carrying fragile positions you do not really understand, simplify. If you own good assets but cannot emotionally survive another ugly week, resize them. If you have dry powder, think more about quality and structure than about drama. The file itself says this should be a structured plan, not gambling. That is exactly right. Felicite Turn 41 file 0 Fe and structured plans outperform panic almost every time. Now I want to end where real money decisions begin, with the difference between wanting to be right and wanting to be positioned. A lot of investors still spend crisis periods trying to prove they understand the news better than everyone else. That is ego work. I have very little use for it. The only thing I care about is positioning. Am I holding too much fragility? Am I confusing a forced sell-off with a broken thesis? Am I chasing what already moved? Am I ignoring what the bond market is telling me because the television is louder? Am I buying glamour when I should be studying toll booths? Am I exposed to the wrong side of the rate path if the next phase turns from inflation fear to growth panic? Those are the questions, not whether I can win the argument at dinner. If oil really makes a run at $200, a lot of portfolios will be obliterated, not because the owners were stupid, because they were still playing a cheerful version of a market that no longer exists. They assumed cheaper money would arrive on schedule. They assumed energy was just a sector. They assumed gold would behave politely according to the textbook. They assumed the chain reaction would stay contained. That is what breaks people, not lack of intelligence. Wrong model. So here is the final choice. You can keep thinking of this as separate stories. War over here, oil over there, gold acting strangely over there, the Fed making another policy choice somewhere in the distance. And if you do that, you will likely keep reacting to symptoms. Or you can do the harder thing. You can see the chain. You can watch how a shipping risk becomes an oil shock, how an oil shock becomes an inflation problem, how an inflation problem becomes a central bank trap, how that trap becomes a bond, market message, how that message hits mortgages and growth assets, how forced selling distorts gold, and how the eventual policy answer creates the next set of winners. That is the real framework, not panic, not slogans, not buy this now hysteria structure. And if you can think in structure while others are still trapped in headlines, then this will not only be a dangerous market, it will also be a market full of opportunities that only look invisible to people who have never learned to follow the chain reaction all the way through.